Hello and welcome to lesson number 5. This is a bit of change of gear for the course. Up until now we've had a broad perspective, learning about the core fundamental principles about price movement and order flow mechanics, really with the intention of helping you understand the bigger picture with regards to how the market actually works and what moves the prices. With that foundation laid, we're now going to look in more detail at finding the best opportunities, and that means looking at the core volumes and the bid and ask indicators. The dashboard gives you the bird's eye view of the market and directs you to the best overall conditions, and these indicators zoom in a little bit more for some precision and timing of your entries and so on. And I'm going to start with the core volumes, beginning with a look at what it actually measures and where that data comes from. If you're new to Forex, you might not question this, but if you've been around the currency markets for some time, you'll know that customer side volume information is not available. We take it for granted in other markets that you can see the size of each order that gets executed, but that's because other markets are traded on specific exchanges that are very transparent. Forex is considered an opaque, over-the-counter market that isn't traded on a single exchange. You can change your money with thousands of private banks and other institutions anywhere in the world, and there is little to no reporting requirements. And as such, we can't see the actual orders. We can, and we always have been able to see the level 2 central limit order book, the depth of market or the supply of liquidity, but that tells us what market maker liquidity is doing. It doesn't tell us anything about what the customers are doing. And of course, it's the customers who drive the price moves, and we can't see their orders. But actually, that's only true for the spot market, and there is in fact a kind of backdoor way to track the genuine order flows. And it begins with understanding the structure of the Forex market. The $5.1 trillion Forex market is actually made up of multiple components. We trade the spot market, but that's only 33% of the total market. You've got currency options at 5%, futures at 14%, and swaps at 49%. Now, the spot market is the over-the-counter, decentralized segment without any central exchange and almost no reporting requirements. We can't see the size of the orders in here. This is the part that is absolutely invisible to us and everyone else. Even the banks and hedge funds can't see what's happening in here. But in every other segment, the orders are executed on properly regulated exchanges, and the orders are reported. We know exactly who is trading and what size their orders are. And this is where it gets interesting. Most people don't really understand what a swap transaction is. Retail traders certainly haven't got a clue. A swap is a currency exchange in the spot market combined with a simultaneous futures contract for the same amount in the other direction. And I'm not going to go into all the different reasons why people use swaps, but it is basically a hedging and risk avoidance strategy. So let's say that I exchange dollars for euros in the spot market. I want to sell dollars to buy 1 million euros. In real terms, using today's exchange rate when I'm making this video, that means I handed over $1.16 million and I received 1 million euros. So that's basically the same as buying 10 lots on the euro US dollar. At the same time, I would take out a futures contract to exchange my 1 million euros back into the $1.16 million 30 days from now, or some other date in the future. That's what a swap is. It's an instant spot exchange in one direction, and the agreement to exchange that same amount back again at the same price at some time in the future. And it's that futures contract that's regulated and reported. We can see this. So in my example, my futures contract was to sell 1 million euros to buy back $1.16 million. In other words, sell 1 million euro US dollars at this exchange rate. Anyone who looks at that will immediately know that I must have just bought 1 million euro US dollars in the spot market on the other side of this swap transaction. And that's what this indicator does. It looks at all of the futures contracts in the swap market and inverses them to discover what spot orders must have just taken place. So that's a pretty clever way of finding out what's happening in the spot market, isn't it? Now, look at the size of these segments. Spot is $1.7 trillion per day. Swaps are $2.5 trillion. Half of that swap is a spot trade. And all of those spot trades combined is a total of $2.95 trillion. And we can see 1.25 trillion of those, which is just over 42%. So we can see 42% of the total spot transactions that happen in the wider market. But it does actually get a little bit better than that, because we also look at the outright futures market as well. And you may have heard of the COT report, or the Commitment of Traders. It's a report issued each week by the CFTC, and it tells you all of the positions that are being held by traders in various futures markets, including currencies. But the problem with the COT report is it is so delayed. It tells you what happened last week, so it's of zero use to short-term traders. The other thing with outright futures data is it's a derivative market, and that means it derives its price from the spot market. In other words, the price changes in the spot market and then the futures price changes. So it's a little bit lagging even in real time. It's a little bit like a normal chart. But the information is still valuable if you could get that data in real time, because traders are still responding fairly rapidly, and the order flow in here is extremely closely correlated and indicative of the order flow that's happening in the spot market. If it happens in here, we know that it has also just happened in the spot market. So we do look at this as well. And the outright futures market is $700 billion per day. So we add that to the $1.5 trillion worth of spot trades in the swap market, and we're now measuring $1.95 trillion worth of transactions from that total of $3.65 trillion. So we're actually seeing 53% of the real customer side orders that are being executed. So we're still not able to see every single order, and that's why the indicator is not 100% predictive, and why it is so important that you learn to use it properly before you can expect it to help you make money. And if you're thinking that 53% of the market is not good enough, just remember that nobody, not even the banks and hedge funds, can see that other 47%. We're seeing every order that it is possible to see, and that is 100% more than a typical average retail trader can see. They see no orders at all, but we're on a level playing field with the hedge funds. This data is actually something that institutional traders have been using for years, but it's something that has only been available to them. Until recently, the data supply simply wasn't publicly accessible. You couldn't get it if you were outside of a large institution, so retail traders have always been excluded. A number of these data providers, though, have now opened it up, but it is still prohibitively expensive for most people. The different data aggregators can charge between $10,000 and $50,000 per month just to stream this, and you need access to several of them to get the complete picture. And that doesn't then include the programming costs to actually decipher and make sense of the raw numbers. So you can understand why this is out of reach of retail traders and why no one else is able to use this. We have now, though, got that raw volume data from these aggregate feeds, and we've overlaid it with a number of proprietary algorithms to filter and weight it, and we can display the information for you in a very simple looking and intuitive core volumes indicator that sits directly on your charts. Right, so that's where the data comes from. Now let's look at what we actually measure and calculate. In the simplest of terms, it measures the size of the orders, but more specifically, the difference between the buy orders versus the sell orders. If there are 20 million sell orders and 40 million buy orders, the total volume is 60 million. But the total volume like that isn't much use to us because it doesn't tell us which side is more powerful. If you attach a regular volumes indicator that comes with most charting packages to a chart, it tells you the total tick volume. And sometimes you can get a really big price bar like this with small volume, and you can also get a really small price bar with high volume. Remember, we discussed tick volume in the last lesson, and while it's really useful for telling us where the order activity is, it tells us nothing about whether those orders are buying or selling, or what the imbalance is. What's really happening in these examples is, with this bar, there is high volume and lots of orders being submitted, but they're probably almost equal in the number of sells versus the number of buys. In other words, there's no imbalance, and therefore the price doesn't move very much. Whereas with this bar, although there are fewer orders and less activity, it's almost entirely sellers and no buyers, which means there is a huge imbalance, and that's why the price moves a further distance. It's the imbalance of volumes that's more important to us, and that's what this indicator, or our indicator, measures. In our example of the 20 million sell volume versus 40 million buy volume, The ratio is 2 to 4, which expressed as a percentage is 50%. And the indicator has a scale of 0 to 100. At 0, it means there is no imbalance at all. There could be 1 million sell orders and 1 million buy orders, so the imbalance is 0. But we could have 1 million sell orders and 2 million buy orders. And in that case, the imbalance is 50%, and we would get a blue bar halfway up the indicator. If at any time there were no sellers and only buyers, we would see this at 100% imbalance. And that is primarily what this indicator measures, the total imbalance between buying and selling volumes. But an imbalance isn't just the volumes, it's the participant behind that volume. Some market participants are more important or more significant than others, even if their orders are actually the same size. Futures contracts are always reported with the institution behind that order, and they're basically grouped into 3 categories. You've got commercials, non-commercials, and non-reportable. Commercials are primarily not profit motivated, and by that I mean they're using the currency markets for utilitarian purposes for other business objectives like buying and selling goods. They use Forex to facilitate their business rather than Forex actually being their business. The non-commercials are more profit motivated, and Forex is very much their business. This is where the hedge funds and other big speculators and things like the bank dealing desks are grouped. These guys are trading Forex because Forex is what they do as part of their business. Then the non-reportable group are traders who are just too small to qualify in either of those other 2 groups. Retail traders are in here, and anyone else who is typically too small to really move or impact the market. With that in mind, we want to take most notice of the commercials, but especially the non-commercials more than anything else, because these are the big players who lead the market, whereas the non-reportable group tend to be the followers. So by looking at the institution or the entity submitting the orders, we can weight them by degree of importance and pay more attention to the more important orders and less attention to the less important ones. And we'll come back to that a little bit later on. The final thing that we look at is open interest. Open interest is basically the measure of whether new positions are being opened or whether existing positions are being closed. When new positions are being opened with new participants coming into the market, open interest increases. And when existing positions are being closed and those participants leave the market, open interest decreases. Open interest is different to volume, and this is a very important thing for reading this indicator. Every new order adds to the basic volume. If we have 10 new buy orders for 1 million each, the buying volume is 10 million. So that's clearly an increase in buying volume. If all 10 of those orders were new positions being opened, then open interest would also increase. We've got 10 new participants that are active in the market. But if those 10 buy orders were existing sell positions that were now being closed as previous sellers cashed out and left the market, then open interest would decrease because that's 10 fewer participants in the market. If the price is rising and open interest is increasing, that's a strong move. There are more new people coming in and joining that move. But if the price was rising but open interest was decreasing, it means existing buyers are closing their positions and leaving the market, and that makes this move weaker and more likely to stop. So that's 3 things that we're measuring: buy and sell volume imbalances, the market participant responsible for the volume or the significance of the institution placing the order, and then the open interest. And we've got a unique algorithm that assesses all 3 of those factors side by side, and then it prints out what we would consider the most accurate picture of what the order flow is really doing and how that will relate to the future price movement. So let's just go through an example. Here we've got the Euro US dollar, and I'm going to start with just a regular tick volumes indicator, which is just telling us the order activity when orders are submitted or removed from the market. This is basically all an amateur trader has available. Now, as the price steadily rises over this area, the volumes are up and down. They don't really have any apparent correlation to the price. Here we've got a small price bar with a fairly high volume. This is a slightly bigger price bar, but this has got less volume. And this is almost exactly the same size price bar, and it's got an absolutely tiny volume. So the whole thing is all over the place. There's no real causation or correlation. As the price then makes bigger moves, the volumes do increase to match those moves. But then the volumes stay quite high after that, even though the price bars begin to get smaller, and the overall rise in the price just grinds to a halt in a sideways range, despite having those big volume bars. The interpretation from that would be that back here, the overall price was moving up, but total volumes were a little bit more random. And then here, as the price made much bigger moves, more people were coming into the market and following that price up. Back here, it was actually quite hard to see if this was a real trend or not. But by this stage, with more hindsight, the trend is far more obvious, so of course more people begin to react to that and join the trend. As the price continues to creep even higher, even more people are now responding and more orders are being submitted, so the total volume increases, or at least it remains high, even when the price fails to rise as quickly as it previously was. At this point, you'd be forgiven for thinking this trend was going to continue. But now let's stick the core volumes indicator onto the chart and compare what that shows us. Well, from right back here, we can see the fundamental shift in conditions. Initially, there was an imbalance to the sell side, shown by these red bars, and it flipped over to show us there was greater buying volume with these blue bars. And this was before there was any noticeable change on the price chart or the regular volume indicator. Then we saw a steady increase in buying volume as the price slowly crept up. There's a definite pattern in the core volumes indicator there, where there was no pattern at all in the regular volumes. These bars are increasing in size because not only was there a growing imbalance between buyers and sellers, but open interest was probably increasing as well. And there were probably more non-commercial participants active who tend to move the market more than commercial participants. Then we see the big jump, and again, this would correspond to increased imbalance, but also increased open interest. More new positions were being opened and more new participants were joining the move. And then this is where the indicator begins to really differ. The regular indicator shows continued high volume levels, even increased volume, whereas the core volumes indicator shows a rapid fall. What's almost certainly going on here is there are more and more orders being submitted, hence the greater overall tick volume. As the price continues to go up and the trend is even more obvious than ever, slower traders, especially the non-reportable participants, which includes uninformed retail traders, jump onto this move. So they do add to the order activity and volume. But at the same time, lots of participants who are in the buy trades from back here begin to close their positions. They're now banking their profits and getting out. And to close a buy, they have to sell. Those sell trades are counted as pure volume. So the total volume does increase when you add them to the new smaller participant buy orders that are coming in. But of course, by selling, the imbalance between buy and sell volumes decreases. So this indicator is going to show you smaller and smaller bars as people begin to sell and close their previous buy trade positions. And just as importantly, open interest is obviously now decreasing as well. As the buy positions were opened back here, open interest increased because more and more participants were joining and becoming active in the market. Now, as those traders close those positions, they leave the market. There are now fewer people active, and our indicator is measuring that open interest, and it's going to decrease the size of these bars even more. The price is still rising because there are buyers coming in and the imbalance is still to the buy side, but the imbalance is falling. It's getting less and the open interest is getting less. So our indicator displays that. And pretty soon the price stops in its track and actually even reverses slightly. Can you see how it's really showing you what's going on at the micro level with order flows? And it's those order flows that dictate price. You can't determine any of that looking at a chart or looking at regular volumes. I've got a few examples here to demonstrate the general rules for this. Bear in mind, these are artificial, that I've just created in a very exaggerated form to be able to illustrate the general principles. You're never going to see anything quite this smooth and uniform, but these should hopefully hammer the concept home. If the price is rising and the blue bars are also rising, this is a really strong move. It means that buying imbalance is increasing, more non-commercial traders are involved, open interest is increasing. If the price is rising but the blue bars are falling, this move is getting weaker. It means the buying imbalance is decreasing, there are fewer non-commercial traders involved, or perhaps there's an increase in commercials and non-reportable participants, and open interest is now decreasing. It doesn't necessarily mean there's going to be a reversal in price, but it does mean that the current move is weak or weakening. And the same situation is true in the opposite direction. If the price is falling and the red bars are rising, this is a strong downward move. It means the selling imbalance is increasing, more non-commercial traders are involved, and open interest is increasing. If the price is falling but the red bars are falling, this move is getting weaker. It means the selling imbalance is decreasing, there are fewer non-commercial traders involved, or perhaps an increase in commercial and non-reportable participants, and open interest is decreasing. Again, doesn't necessarily mean there's going to be a price reversal, but it does mean that the current move is weak or weakening. Now, let's quickly have a look at this grey horizontal line. This is a threshold level where, as a general rule of thumb, anything below this is not really worth taking much notice of. Anything above it is worth looking at. Typically, if the bars are below this level, the price is not going to be doing very much. And if it is moving, it's a lower probability move. Whereas when the bars go above this level, the price tends to move a lot more, and those moves are higher probability. So quite simply, the bigger the bars are, like this cluster here, the better the price move is going to be. Now, of course, the thing to remember with this indicator is it's looking at the customer orders. That's only half of the price equation. Prices move because of supply and demand imbalances, not because of customer buying and selling imbalances. So we've got to look at the market maker supply side, and that is what the bid-ask indicator does. Now, lessons 3 and 4 both covered how market makers operate and how their provision of liquidity interacts with customer orders. So I'm not going to repeat any of that information here. All I want to show you is what this indicator measures and how that information should be interpreted. We start with the depth of market, and this is what market maker orders look like. The best or most competitive bids and offers are what we see on our chart. We just see those two prices, but there are other pending orders behind those. So we end up with this ladder effect. And typically, the liquidity is fairly evenly balanced on both sides. Market makers tend to submit equally sized orders on both sides because, well, that's how their business model works. So now let's say we've got a customer buy order coming in for $9 million. Well, that's way bigger than the supply, as you can see. So it consumes this order, and then the next one above that, and the next one above that, and so on. The demand from this larger customer order basically eats through the liquidity at each level until that entire order is filled. Now think about what that means from the market maker's perspective. Their business model is to sell high and buy low, and vice versa. Ideally, they deal with the customer on the one side, and then they immediately turn around and deal with another customer for the exact same amount in the other direction, and that's how they profit from this small spread. So right now, they've sold $1 million to this customer, and they would like to buy $1 million from someone else. And there's a gap here. And if they're going to get a deal with the next customer who wants to sell, they need to be the most competitive price in the market. So what they do is improve their bid to be the best in the market by adding a new one into that gap. But this big customer also takes the next level of liquidity here. So there's another gap. The market maker has now sold $2 million, but yet hasn't bought anything. So he's even more eager to now trade in the other direction. So again, he improves his bid to try and attract a new seller from somewhere. And this process just repeats. And what we see are offers progressively getting worse, and the bids are progressively being improved and going higher and getting better. Liquidity is being removed from above the price, and it's being added freshly below the price. This indicator counts all of that, and in this example, the offer was improved 0 times, but the bid was improved 9 times, so the net difference is 9, and we would have a green bar painted on the indicator like this. Now, think about what that's telling you and why it's important. It's telling you where market makers are pushing their liquidity. In this example, they're pushing more liquidity on the bid side, below the price. Ultimately, that's all it's telling you. If we stick purely to the facts of what we know for certain, in this example, market makers improved their bid more than they improved their offer. That by itself doesn't tell us where the price is going to go next. It's telling us what's happening now. But when we use that information alongside the customer core volumes, it does tell us what kind of price move is more likely and a lot easier. Just think about it. If customers are buying and the price is going up, and market makers are pushing more liquidity under the price and less above it, it's being removed above, the price is certainly going to find it easier to go up than down. But imagine if we saw this situation. So we've got our big customer with his big order, and just as before, he takes this first level of liquidity. But this time, instead of the market maker following that up with an improved bid, they actually fill that gap with an improved offer. On the first order, the price went up, but now it's gone back down again. And now the customer takes that new improved offer, and again there's a gap, and the market maker again fills that gap with a new improved offer. And again that process repeats. So notice what's happening there. The market maker is improving their offer, not their bid. So the indicator would paint a red bar in this situation. There's more liquidity being pushed above the price than below it. And what does that mean for the price? Well, it's finding it harder to go up, isn't it? Every time one level is taken, a new one pushes down into that gap. So the customer could actually end up getting the entire order filled without the price moving up hardly at all. Can you see how that situation basically acts as resistance? In the first example, the price was moving up easily in the direction of least resistance, or the least liquidity. In the second example, the price was trying to move up in the direction of most resistance and most liquidity, and unsurprisingly, it struggled. So with this indicator, it's not good enough to just look at it in isolation, just as it's not good enough to do that with any indicator. You've got to use this and all our tools alongside all of the other tools that we have. All of these are merely giving you information. They're telling you what's happening with certain participants and in certain parts of the market. It's only when you learn to combine all of that information and you see how each part relates and affects the others that you'll be able to exploit the edge that all of this is going to give you. So obviously, I know you've now got a lot of outstanding questions, and what you really want to know is how to use all of this. What patterns are you supposed to look for, and what conditions produce the best profit-making opportunities? Should you use this in low or high time frames? Can it be used even on different time frames, and so on? Well, those sorts of questions are a whole lesson by themselves, and so that's what we're going to do in the next lesson to wrap this course up. Tomorrow's lesson is all about putting everything together and using the dashboard, the core volumes, and the bid-ask indicators to read exactly what is going on in the market properly and identifying the very best conditions that you can exploit for profits. This has been a pretty intense week of learning for you. It's certainly a crash course in trading at the professional level, but I hope you'll agree it has been worth it so far, and you've already discovered a way of trading that hands down beats what everyone else is doing. Hopefully, it all makes logical sense and you are excited about the possibilities. In the next lesson, we're going to put all the pieces together and show you what this really can do. If you've got any burning questions at the moment, please just hold on to them for now, because the chances are I will answer them in the next class. That's the interesting one, because it's going to show you how to take all of the theory that you've learned so far and put it to practical use. So as the saying goes, the best is yet to come. For now though, I'll end this here. I'll state the obvious, as I have all week, that it's probably a very good idea to rewatch this lesson and make some notes. Thanks as always for giving me your time today, and look out for lesson 6 being released tomorrow. Thank you.